Well, it's the weekend and we're back with your favorite investing show, Smart Money. Now, this week on Smart Money, we're going to learn about the importance of investing in index funds. And Mohit Gang, the co-founder and CEO of Moneyfront.in, is with us to talk more about that. Mohit, welcome to the show. Now, passive funds don't enjoy as much of the limelight as active funds do. And they seem to be really underrated, right? Because the kind of returns that passive funds give you, the kind of stability, safety that they give you is much higher than perhaps active funds. But let's start from the very beginning. What are index funds for the benefit of our viewers? And what are the advantages of investing in index funds?
Hi, Sonia. It's always a pleasure to be on your show. Wish you and all your viewers a very happy 2022. And I think it's one of my favorite topics to start the year, which is why passive investing and why index funds per se, right? And at the very start of it, at the very core of it, index fund is nothing but mimicking a benchmark to the T. So exactly the weights which a benchmark will have. So let's say if you're mimicking Nifty 50, whatever weights each individual stock in Nifty 50 will have, exactly in that weight, that same proportion, same sectoral allocation, you will fabricate a similar looking index and invest into that. And that's index fund. Totally passive, no active involvement, no fund manager, no research required, and fairly simple to do and easy to do basically. And that's the concept. It started in US late in 1975 by Jack Bogle, actually, who's considered as founder of index investing. And since then the industry has become manifold. In US, in fact, last 2 years passive investing has become bigger than active. It's now having a bigger share than what the active funds have. So it's catching fire everywhere.
I have many questions for you on this, but you said there's no fund manager involved, there are no research analysts involved, so I'm sure the cost is also low. But how low? What is the expense ratio as far as a passive fund is concerned compared to an active fund? And how much money would you be saving by investing in index funds versus, in an active mutual fund?
Look, Sonia, one of the key reasons why people get into passive funds or index funds is because the cost structure is very, very low, right? You don't have to have exorbitant salaried folks or research teams to maintain it, and you don't have to have any systems or processes. You just need to build an algo or a system which will just exactly mimic the index. Just to take examples, let's say a normal active large cap fund in India today on the direct plan will have a cost structure of 1 to 1.5%. On the regular plan will have a cost structure of 1.75 to 2.25%. Whereas an index fund, a Nifty 50 index fund in direct plan will have a cost structure of 0.20%, which is 20 bips, right? So there is a difference of good 1% between the direct plan of an active fund, large cap, and an index fund, Nifty 50, which is a massive difference. If you compound that year on year for next 10-15 years put together, it creates a huge lot of difference in terms of the returns, and it makes the task of an active fund manager that much more difficult to beat the index because of this cost structure.
Absolutely. And I think not just the cost structure, right? I mean, if you eliminate the fund manager altogether, then there is no investing bias. I mean, you're not relying on one person's personality, one person's investment ideas to manage your money for the long term. And for me, I think that is the biggest advantage as well of just investing in index funds, that investing bias is completely out of the way. But all right, Mohit, tell us about what are the different types of index funds?
Absolutely. So there are many types of index funds. The most prominent ones in India are the bigger benchmark index funds, which is the Nifty and the Sensex index funds. So I think we have almost like 11 Nifty 50 index funds in the country and around 5 Sensex funds in the country. And now we are getting into the second phase of having index funds, which are like more sectoral funds. So you have a banking index funds, and you are also getting into factor-based index funds, right? So these are not exactly passive, these are not exactly active. It's a synthetic approach somewhere in the middle. And these are also called smart beta index funds, and we will talk perhaps a little more about later. So that's one. You have debt based index funds now, and you also have commodity based index funds, which are the gold funds. And now the silver funds are also coming into the market in this month. So there are plethora of index funds. For international investing also, Sonia, there are funds which mimic exactly NASDAQ 100 and S&P 500 indices. And there are a few other international index funds also which are available in the market. So varied forms and types.
Okay, varied forms and types. I want to understand about smart beta investing. I'm sure it's in the middle of active and passive funds. But just to revisit the advantages of index funds, low cost structure because there's no fund manager in the middle, there's no big research team, so the cost is very low. There is also individual stock and sector restrictions don't apply on index funds. You're basically just mimicking the entire index. Complexity of the scheme size and continuous EPFO flows, and of course, there's no investing bias. All right, so we've established what the advantages are. But what are the disadvantages, Mohit, of investing in an index fund versus an active mutual fund or a plain vanilla mutual fund?
Sonia, I'll just add one more point out there. So I think whatever you've highlighted is absolutely relevant. But the biggest point about index funds is not just cost. It is also that consistently no active fund manager, especially in the large cap space in India, has been able to beat index. And consistently is the operating word out here. You will find every quarter a new fund, a new active fund manager who's the winner. But consistently for quarters and years put together, you won't find a fund which has beaten the index, right? So that underperformance per se, and it could be attributed to multiple reasons. So SEBI has done a lot of reclassification. The schemes have become very big in size. There is a lot of EPFO money which is coming in, which is driving the index based stocks further up. So it's becoming very, very tough for active managers to beat. On the disadvantages side, look, India is still an evolving market. The indices are not so well defined, and there are not so many criterias on which you find multiple indices. Only the broader indices are very well defined, which is Nifty and Sensex. But other than that, there are liquidity issues. The fund sizes are not very big in some of these cases. And plus, I think sometimes you get that feeling that why am I investing absolutely totally into that index when I know that some of the parts of this index, so let's say for Nifty, you might just not want to be in PSU stocks, right? But because it's a part of Nifty, few of these stocks, you have to be investing into that. So those are some challenges which you need to figure out how to kind of manage those things. So those are a few of the bigger disadvantages of being into index funds.
Okay, well, it's nice that you gave us that statistic that, in the longer term, consistently, no active fund manager has been able to outperform index funds. So if you're in it for the long haul, which most of us are, it's better to just invest in an index fund. Now the big question, right? Which are the index funds that one should look at? So if let me give you an example, Mohit. If I am a salaried employee who has no time to look at the market but wants to invest blindly in an index fund, which are the safest ones, the good names to invest into, your top 4 or 5 choices?
Okay, look, so I think index funds is meant for investors who want to sleep peacefully. If you want to like really forget about your investments, buy once and shut it out for like 10 years, 15 years, 20 years, pass it on to the next generation. There is no simpler and easier way, because then you don't have to bother of going wrong year in and year out, right? So you don't have to do that rebalancing bit every now and then. So safer bets absolutely must have is a Nifty index fund in the portfolio. That's the largest index in the country, most liquid index. And basically you are buying the top 50 companies by market cap in the country. So must have Nifty 50. On the large cap side, you can have one Nifty next 50 also. So that covers the top 100 stocks in the country by market cap, right? And then the other ones, basically you can have a mid cap index or a small cap index. However, I should just put a disclaimer out that on the mid cap and the small cap side, active funds still are outperforming the index. But as market matures in next 5 years, 10 years, that outperformance will keep tapering out, and it will become incrementally difficult for active fund managers to consistently beat the index. So you should have a mid cap and a small cap index also, and perhaps one international index fund, Sonia. I think that's the best thing to have in a portfolio. Buy a NASDAQ or an S&P 500 index fund and just sleep peacefully. Your US allocation is done forever.
Okay, I think sleep peacefully is the operative word, right? Who doesn't want that these days? But just to revisit, of the top, the Nifty 50 is the most popular choice in index funds according to Mohit. And he says of these, UTI, HDFC, ICICI and SBI are the biggest funds that have 1,000 crore plus AUM. So perhaps those are the safest bets that have Nifty 50 index funds. The other popular options are Nifty Next 50 with 11 AMCs and Sensex funds with 5 AMCs. So, sleeping peacefully at night, if that's your objective, then index funds are the way to go. Before we take a break, let's talk a little bit about taxation. Is taxation, are these index funds taxed differently from plain vanilla mutual funds? And how do you go about that?
Okay, so just two more points to add on the last point, Sonia, before we move on to taxation. While selecting an index fund, because we were giving out names, just take care of two parts. One is keep the expense ratio the lowest and just check the tracking error. Tracking error can be a difficult number to figure out, but if you check the beta of the funds, which is readily available across all websites, the closer the beta is to 1, that means lower is the tracking error. It's just another name for tracking error, basically. So see for the lowest expense ratios, least amount of tracking error or the beta closest to 1, and AUM of a decent size, and there you get a good combination to select an index fund, and that's what we have given in terms of our recommendations. Now hopping on to taxation is
Okay,
exactly similar
Mohit, just one more follow up there. You were talking about, we'll come to taxation in a bit, but these are two important things that you spoke about, the tracking error and the expense ratio. Just for the benefit of our viewers, what's the definition of both of these? And, for people, it's hard enough to find the mutual fund data and the stocks that they have in their portfolio. How do you, if you can just drill it down, where exactly can you find the tracking error and the expense ratio of an index fund?
Okay. So TER, or the total expense ratio, is what the scheme requires or kind of deducts the money from the NAV of the fund for its operating expenses. And these operating expenses could be fund manager's salary, or the fund house expenses, or the distributor commission, and so on and so forth, right? So that is absolutely available on any website of mutual fund research will give you the number of expense ratio. It can be for direct plans in index funds, it will be 0.2 to 0.3 odd percent. For active funds, it will be between 1 to 1.5 odd percent, and you can easily figure out that number. It is available on fund fact sheets also and fund house websites also. Tracking error is a difficult number if you start looking by the word tracking error. So search by the word beta. Look out for beta of the funds. Beta is the sensitivity of the fund to the benchmark, which means if a benchmark is moving by 100, how much is the fund moving? So you will find beta of index funds typically 0.99 to 1 to 1.01. That's the range. That's a good beta to have. If any of the schemes is having beta lesser than 0.95, that's a matter of concern, which means the tracking error is higher and that fund could be avoided. So look at beta, which is closest to 1, and that's a good fund. Along with that, combine it with expense ratio, low expense ratio, high beta, as in beta closer to 1, and that's a good combination to go for.
Okay, you know what? We actually have done that calculation. Mohit has done that calculation of which are the funds that have the lowest expense ratio, and their beta as well, is less than 1. So what we'll do is we'll take a quick break on that note. We'll come back and we'll try and give you the list of all of those funds that you perhaps need to invest into, all the index funds that will make you the most money and help you grow your corpus. Lots coming up in just a bit. Welcome back. You're still watching Smart Money on CNBC TV 18, and we're discussing the importance of investing in index funds if you want to grow your portfolio and build a corpus. We have Mohit Gang of Moneyfront, and before the break, we were talking about the pros and cons of investing in index funds. There seem to be more advantages because index funds are low in cost. You don't have a massive team, investing actively. It's just mimicking the index, so the expense ratio is low, the cost is low, and of course, you get to sort of enjoy the benefits of the growth that we're seeing in the overall index. So you have a diversified portfolio as well. Mohit, let's talk about taxation now. Is it any different if you invest in an index fund versus an active mutual fund? Is it taxed differently?
Look, so different categories, you will have to put it out separately. Indian index funds, which is Nifty, Sensex, Next 50, so on and so forth, they are all taxed like equities, which is long-term capital gains after 12 months of holding will be 10%, and first 1 lakh of long-term gains is exempted. And short-term, which is less than 12 months, is at 15% capital gains. But if you're investing into international fund of funds, those are considered as debt investment. So debt taxation applies. If you are investing into debt index funds, again, that is debt taxation. And if you're investing into commodity base, which is gold and silver index funds, those are also considered as debt for purposes of taxation. So out there, long term is 3 years and above, which is 20% with indexation, and short term is at your marginal rate of taxation. So it's clubbed into your income and taxed at marginal rate. So you will have to keep the index funds separately for tax purposes.
Okay, all right, got that. Now, before the break, you were telling us that there are plain vanilla index funds that mimic the index, and then there's factor-based index funds. Is this like a hybrid between active and passive funds? And just tell us a little bit about it. I mean, which kind of investors should go in for factor-based investing, and what exactly are these funds?
Oh, absolutely. This is the new rage and the new fad in the town. So basically, a factor is nothing but a quantitative strategy applied to an index fund. So it's neither passive nor active. It's somewhere in the middle. So what essentially the argument is that when you are totally passive, you end up buying wrong constituents of the index also. You end up picking stocks which are just not showing any momentum or just not showing any value or whatever, right? So you apply one more filter on the passive strategy, which could be a value filter, a momentum filter, or an equal weight kind of a filter. And there are multiple factors, right? These are all quantitative factors, and each fund will mimic a particular quantitative strategy. So you overlay that, and it becomes like a synthetic product between a passive and an active. Again, there is no fund manager, but there are quantitative tools which are applied to make it a little more active and outperform the index funds per se, right? So that's the whole theorem. I kind of call it a masala product, basically, which is more like a masala sprinkled over the normal variety. And it's also called smart beta funds. So I think people popularly call it as smart beta funds, which are available in the market. In India, they have just recently come into play last 1 to 2 years. More so, you have 3 or 4 equal weight products. Then you have a momentum product, a value product, a quality product, and these are all overlays on a passive strategy.
Okay, so tell us, what is an ideal allocation to factor-based funds? I mean, if I want to sort of put some money to work in index funds and get a little risky with factor-based investing as well, what should the ideal allocation be, and what are the top funds? If you can just give us some names that one can look at.
Look, Sonia, again, this is being more experimental with your overall allocation. My first recommendation would be that always have a passive, a pure play index fund, basically. And then if you really want to have some tactical allocation to kind of enhance your returns, then play out a factor-based thing. Maybe around 10% of your portfolio could go into these kind of options. Out there, personally, I like the momentum based funds more, because that's what the market has been typically for last 2-3 odd years. And even if you see the history of the markets, basically momentum ends up playing well globally. Also, momentum based factor investing has actually done fairly well, though you will find value based factor investing, and there are investors who will argue for it that in a market like this, if you can go for a value based factor, right, it might serve long-term purposes, but then it will not give you immediate returns. It's a very wait and watch kind of a strategy. So personally, if you ask me, I like the momentum based things. There is one section of market which believes in equal weight. Now, which is like saying that all 50 companies of Nifty being given 2% weightage in the portfolio, and that's how you make the 100 rupee allocation. Now, I personally don't like it much, because look, if a Reliance outperforms the market and it has like 10% plus or 11% weightage on the index, then you are massively underperforming in that kind of a strategy, right? And if there are stocks which are less than 2% weightage in the Nifty, if they outperform, that is when you actually gain in that strategy, which again is if the index per se does well, the heavyweights will do the heavy lifting actually. So if you ask my choice, I like the momentum based themes more in factor based investing. And out there you have a UTI fund which has done fairly well. The corpus is good, over 800 odd crores. It's Nifty 200 momentum 30 index. That's a good one to go for.
Okay, got that. So those are a couple of funds that Mohit is recommending. But just wanted to understand, because we're getting a lot of queries as well, Mohit. So I'm going to toss this to you. What is the advantage of index funds over ETFs? Because a lot of people are now preferring, this ETF route for investments. Is there any big difference?
Oh, not at all. Not at all. They're brothers and sisters, basically from the same mother. So absolutely no difference. It's just about how you are comfortable buying a particular thing. If you're comfortable dealing with a broker, buying it on the exchange, then you go for an ETF. If you're not comfortable opening up a demat, holding a demat, paying those demat charges and calling a broker or buying it online or whatever, you just buy it in a mutual fund format. The only advantage you get in a mutual fund format is that you get partial units. So your SIP is much easier and friendly. In an ETF, there is no partial unit allocation, right? So if a particular unit, so let's say if you're doing a gold ETF, if 1 gram of gold is, let's say, 5,000 rupees, then you can't have a 7,000 rupee SIP going in. You would not have partial allocation out there. So for partial allocation, mutual fund is the best vehicle. Difference is, again, in ETFs, you can get the intraday pricing, but in what do you say, mutual funds, you will get the day end NAV.
All right. Okay. We've actually run out of time, but we would have loved to chat some more. Mohit, as always, thanks a lot for joining us, educating our viewers. And, I'm going to have a separate episode on factor-based investing. It was very interesting, a hybrid between active and passive funds. I'm sure our viewers would love to know more about that. Thanks so much for joining us, Mohit, and have a safe and healthy 2022.
Thank you. Wish you the same.